Hey, good afternoon, everybody, and welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. This is where I want to cover a strategy that you can develop some yield off of the risk capital that you put into play. But before I get into strategy, let's take a look at the markets. Right now, you're seeing that the Dow Jones, and I'm just going to bump this up a little bit. The Dow is trading right now at 20,690, up 141. So a nice bounce, up about 0.7%. You're also seeing the Dow Jones Industrial trading at, or the S&P 500 trading up 15 at 2357. And the NASDAQ. The NASDAQ is really running to the upside. NASDAQ's up 32 at 5406.90. The Russell 2000 right behind it. This is the biggest laggard, though, of the day, up 660. Still hasn't, it's challenging, but still hasn't broken its 20 or 50-day moving average. The battle continues. And the volatility index down almost $1, down 90 cents at 1160. So volatility has dissipated in the market. So you guess you could call this a trend up day if you're a technician. But right now, if you look at the market, and I just want to bring this up, this is what I see. I see consolidation. I see right now a market that has been grinding in these consolidations, right? It's not just been a straight shot up or a straight shot down. It's these consolidations. So how do you take advantage of these consolidating or somewhat corrective, but in a very defined range type of moving markets? And that's where you can utilize a strategy called an iron condor. And so what I want to do is just define it really quick, and then we'll go through a visual example, and then I'll actually jump on the platform and take a look at an example so you can see how you can put this into play. Now, if you have not ever covered a credit spread before, or spread in general, go back on 3/2 of 2017 in the Strategy Now section. You can do the videos. There's a great discussion where I cover all the components of the two spreads that we're going to put together in the iron condor. So what is an iron condor and why would you use it? Well, first of all, an iron condor is when you take a bear call spread. That means that you're selling a call and you're buying another call against it. And then you're selling an out-of-the-money put and buying another out-of-the-money put against it. And these two option spread strategies are called a bear call spread and a bull put spread. Now, you're receiving a credit for both of those, right? And the expiration months are going to be the same, and the difference between the strikes that you're selling is normally the same. So let's take a look at a real quick example on paper. The expiration month, you can see this right here, is October. So it's the same expiration month for the calls that I'm selling and the puts that I'm selling, as well as what I'm buying. So I'm selling the $46 calls. Stock's trading, let's say, at $40. I'm buying the $47 call, so that's my hedge. That's a $1 bear call spread. Then you're selling the $32 puts, and you're buying the $31 puts. And again, $1 between the two strike prices, and they're out of the money. All four of these are out of the money. For that, I receive $33 or 33 cents per contract. My risk is the difference between the strike prices minus the amount that I receive, so $67. Now, the beautiful part about all of this is that not both of these spreads can be in the money at expiration. Either one or the other or both expire worthless. Okay? So your max loss is going to happen, in this case, at 31 and 47. Those are your long strike prices. Right? That's easy enough to understand. That's where your max loss is. Your break even is going to be the difference between your short strike prices, right? You subtract that from the 32 puts, that gives you 31.67, and you add it to the $46 calls, that gives you 46.33. So basically you have a range of 31 to 47. That's where your range is. And as a matter of fact, to stay break even, it's 46.33 to 31.67. So now that we've taken a look at this example, let's actually jump into the platform and take a look at how you would construct one of these in the spiders. Currently, that spider ETF, which tracks the S&P 500, is trading at 235. Okay, so what we're going to do is we're going to look to set up a Condor. Now, some other criteria that I like to put out there. I do Condors with about 45 days until expiration. That gives me a lot of time to be right. The second thing that I do is that I like to put a Condor together by selling an option that has a 30 or less delta, right? So in this case, I'm looking to sell the first week in May. They expire at the end of the first week of May. I'm going to sell the 226 puts, and that has a 16 delta. That basically tells me that there's a 16% probability that this will be in the money at expiration. I'm going to buy some protection, and the difference between this, I'm actually going to do the 221s. I'm going to buy the 221s. So the difference between this is $5, and I'm going to pay 55 cents, and that has a 9 delta. So that's my protection. Then I go look at the calls, and I'm going to sell the 240 calls. Now those have a 26 delta. And I'll receive 88 cents, and I'm going to buy the 245 calls because I don't want to have that unlimited risk either to the upside or downside. I want to basically contain my risk, and that's $5. That's the difference between 240 and 245, and then I'll buy the 245s as protection. So if you scroll up and take a look at this, this is the actual trade. So let's see, I'm going to do this. This is the 226 puts, so we're going to do the 221s. Okay. So I'm going to sell those, I'm going to buy those. Okay. Let me just do this again, and we're going to do put. Okay, so we're selling the 226 puts. That's almost $10 out of the money against where the stock is trading. I'm going to buy protection, though, underneath at 221. So that's a $5 put credit spread. For that, I will receive a credit. That's the difference between the 226 and the 221s. All right? Then what I'm going to do is I'm going to sell the buy the 245 calls, and I'm going to sell the 240 calls and receive a credit there. I'm going to change that to call. And I'm going to receive a credit there. So net, if you take what I'm receiving for the put spread and what I'm receiving for the call spread, I'm going to take in a credit of right around $1.07. So I'd scroll down. Now that represents, credit, my total profit potential, $1.07. My risk is the difference between the strike prices minus that $1.07. So the difference between the strike prices is $5. Minus 107, that means that I have $3.93 of risk, or in other words, I need $393 to do this strategy. Now I did two contracts, which basically means that I have to have close to $800 in buying power available to do this strategy. My rate of return on this is going to be, it's going to be basically about 25% on the risk capital. If you have a $5,000 account, basically you're putting a little over 10% of the account at risk. So you're right now, maybe you may want to scale this back. If you have a $10,000 account, you'll be right within your risk parameters. I know these smaller accounts, you sometimes have a struggle with this, but the point being is that your probability of potential profit is right around 62%. Your probability of taking a profit at 50% of the total profit. So in other words, if I sell it for $1.07, I would cover this at basically around 53 cents. Okay, 54 cents. That's about 82 to 87% probability that it could go down and you could actually capture that potential profit target at this juncture. And the whole point of this is that you want to have a fixed risk, fixed return type of strategy and approach when you're in one of those markets that seems to be consolidating, in other words, neutral, or in a very confined or defined range. Okay? And that's how we can use the Condor strategy. All right, folks, that's it for Strategy Now. Please join me at 3:30 Eastern Time, where I'm going to be going over Tech Talk, where we're going to take a look at some movers. See you here at MarketStream.live.